Let's begin, though, with the big debut on Wall Street today. Bill Ackman's Pershing Square Tontine Holdings bringing to market its latest special purpose acquisition company, or SPAC. The $4 billion IPO, the largest SPAC to date, and offering a 200 million unit at $20 a share. And we are seeing that stock trading under ticker symbol PSTHUN, up roughly 8%. I want to bring in Julia LaRoche, who's been covering that story for us, along with a special guest. Julia.
That's right, Akiko. Well, I'm pleased to bring in Bill Ackman, the CEO of Pershing Square Capital Management, also the CEO of Pershing Square Tontine Holdings. Bill, congrats on the big debut today.
Thanks so much.
All right, so I see shares are trading up more than 8% right now, $4 billion raised, a record here. A lot of talk right now about SPACs versus the traditional IPO. Why now? Why a SPAC? And what do you make of what's going on right now as it relates to public offerings?
Sure. So the basic idea of a SPAC is a good one, which is raise a cash shell, list it on an exchange, and then issue securities to take a private company public. It's a much more efficient process, a much less risky process for the private company. Typical process for a private company, 4 or 5, maybe, could be as much as 6 months to go public. And during that period of time, you're under enormous scrutiny. Your employees are distracted. Media's writing all kinds of articles calling your employees. Financial advisors are calling employees, giving them advice, and no one's focused on running the business. Where the alternative with a SPAC is we quietly work with the senior most people at the company. We learn about the business. We do our due diligence. We enter into a transaction, and the first press release is you're done. Minimize distraction. Certainty, the typical IPO process, it's not until the last day that you know where the IPO is going to happen, what the price is, how much money you raise, and the degree of difficulty goes up the bigger the IPO. So our thesis here is by having a $5 billion cash pile in a public company, it's our own version of a unicorn, right? It's a one-of-a-kind entity. And so we're looking to marry a unicorn. So we're prettying ourselves up. Okay, so yeah. We're the most attractive possible partner.
I was going to say, you're probably getting a lot of calls, and I like that you just analogized it to a unicorn. Speaking of unicorns, you mentioned in the S1 that, you mentioned kind of 4 areas that you are interested in, one being mature unicorns. I know your investment thesis from just covering you in the past. You look for easy to understand, simple, cash flow, generative businesses that are dominant and have a high barrier to entry. Given everything we've gone through, especially as it relates to COVID, walk us through your investment thesis, maybe how that's been reinforced or shifted, and what exactly you're looking for.
Sure, I would say it's really been reinforced. The world is an uncertain place. It was an uncertain place before we had a pandemic. Unfortunately, it's going to be an uncertain place even after we get through this pandemic. The businesses that can withstand the test of time, if you're a long-term investor, that's what you want to own. There are other stocks that might go up more in the short term, down in the short term, and if you trade, you can make more money. If you're particularly good at that, it's not what we do. But we try to find places we can put a large amount of capital, own a meaningful percentage of a business, but the business has to be a super durable company. We don't want a couple people in a garage to come up with a better idea and disrupt us. We don't want oil prices to go up or down and cause the business to be worth less. So our job is figuring out what is the super high quality, enduring company that the stock market could close, pandemics can happen, and out the other side, we own a more valuable company. And we've tried to do that in our portfolio, and we're having a very good year this year. And a big part of that is we own businesses that are super dominant. Chipotle is up 38% for the year because of the nature of their business model, their way they've adapted, their digital offering, their efficient delivery. These are the kind of companies you want to own, in my view.
Bill, it's good to have you on. I like that analogy that you made about trying to marry a unicorn. There's certainly plenty of speculation about what your acquisition targets are likely to be. Names like Airbnb floated around. I'm curious if you flip the script here, what the calculation you think has changed for some of these mature unicorns now that they're seeing what's happening in the markets right now. It used to be last year we were talking about direct listings, and now we're talking about SPACs. What do you think has changed from their end in terms of the calculation on how to come to market?
Sure, I think it's an excellent question. A direct listing I think a SPAC is just a better version of a direct listing. What we bring to the table, a direct listing, you don't raise any capital. There's no one to set a value. What's interesting here is we're going to spend the next few months looking at every potential candidate. We're going to pick the best one. We're going to do detailed due diligence. We're going to understand everything we need to understand about the business. And we're going to negotiate a deal to buy what is in effect a minority interest. We're going to own 15 or 20% of the company once the company becomes public. But when we make that announcement, we will announce that Pershing's investing $1 billion, $1.5 billion in the company. Here's what we've learned about the business. This is why we think it's a really interesting investment. And all of our investors will have a choice. If they don't like the deal, they can sell their stock to someone who does, or they ultimately have a right of redemption. And that creates a very attractive way for someone to go public. From the perspective of the company itself, instead of running around trying to convince people to give you money, which is the IPO process, we're going to make the case why this is a really great investment. We're going to speak with $1 billion, $1.5 billion investment, and we're going to introduce the management team. This is the management team we selected, and they won't have to do the dirty process of raising money, right? And it's just a much more interesting way to go public. We've already lined up a collection of, in our view, the best investors in the world. And we have a group of, sovereigns, family offices, Canadian pension plans, U.S. growth stock managers with great reputations on our shareholder registry. And we will use that as a marketing tool when we're talking to private businesses about here's how you come public. We'll protect you from Wall Street and that whole process. We'll eliminate the risks and uncertainties and distraction and media attention that come when at a very awkward time when you're not quite public. And we'll do a transaction with you overnight. And that is a really appealing prospect that even a direct listing, direct listing still has to go through the entire registration process with the SEC.
I want to get your sense on where you think the broader economy is right now, because when you go back to March, you sort of raised a red flag back then saying it's time to essentially, shut down the economy. This is before we had the shutdowns in some of the states, saying essentially you need to rip the Band-Aid off so that, the quicker we shut things down, the quicker we get this virus under control, the quicker the bounce back will be. When you look at the economic trajectory since, have things fared much worse than you anticipated at the time, or are things better?
So the answer is, had we done a hard 30-day shutdown, we would have had a better outcome on the virus and a more rapid recovery of the economy. What we had was, I would say, something in the middle, a state-by-state led kind of rolling shutdown, and we're having kind of the inverse today and all the problems associated with that. So it's not ideal. But it's much better than the alternative, which is we let the virus run roughshod around the country. So the impact will be, the economy is going to be middling until really, I would say, a therapeutic that works, a vaccine that's beginning to be deployed, or everyone in America wearing a mask, and we just minimize the risk of this virus spreading. So I think it's going to be a tough 6 months, 9 months, but I'm looking toward the back half of next year as the beginning of a real recovery, or something getting back to something approaching normal, with maybe Q1 being a transition moment. Hopefully, Pfizer's vaccine or AstraZeneca's, or there are many other, there's a company called COVAX, which our foundation's invested in. That's an interesting vaccine candidate. We're rooting for all of them, and we hope more than one wins.
Yeah, Bill, it's Julie. I should mention I had the COVAX chairman on last week talking about exactly that. When I look at your portfolio, you have exposure to retail, a lot of consumer companies like Chipotle or Burger King's parent company, Restaurant Brands, Starbucks, and even some hotel exposure and real estate. And I got to say, you're doing quite well this year. But when you just think broadly, you were kind of outlining the recovery. What do the big cities look like, maybe even from a real estate perspective? What's kind of your thought there?
So I think real estate's a really broad category, and it's almost a building by building analysis. But I think in the big cities, so one, I don't think it's the end of office space. I think people are still going to work in offices. In fact, I think office density is going to go down. We've been in a period over the last decade where more and more people are being packed into offices. The number of people per square foot approaching 7 or something like that. And I think you're going to see less density in offices. You're going to see, some percentage of the workforce. I think it's more like 5 or 10 for most companies working, from home, or at least several days from home. But I think office survives, and I do think there'll be certain office space will be outmoded. Sort of the cramped, low ceiling, old-fashioned office space. Probably needs to be torn down and rebuilt. The high ceiling, more modern layouts, outdoor space will be a real premium asset, I think, for offices. Street retail. Street retail rents in New York got to really exorbitant prices and priced out all but the national, global chains. And that led to some, I would say you lose something in neighborhoods. I think the good news, actually, it's probably the best time in history in New York City to open a restaurant. I know that sounds like a funny statement, but rents are going to be lower than ever. There's going to be less competition than ever. And, it's going to be a challenging period through the winter, but I think hopefully by next spring, people will be, I don't know about you, but I am dying to eat out and enjoy all the great things that a city has to offer.
Yeah, we were talking about that earlier. And, just kind of, again, if you look at Starbucks and Chipotle, for example, they're very tech savvy companies. And I know you as not a pure play tech investor, but when you're even thinking, I guess, at the universe of options, how important will the technology component be when you're kind of assessing where you might want to make a deal?
Sure, I think it's an insightful point. I mean, the bottom line is every company today is a technology company, whether you're Lowe's Home Improvement, Starbucks, or a pure technology company. We've never really invested in what I would call a pure technology company. Think Waymo or a self-driving business. With respect to Pershing Square Tontine Holdings, we want to buy a business that we can predict what it's going to look like over a long period of time, and therefore we can predict what it's worth. I think it's very difficult to value what a so-called pure technology company. We want a business that is, we're calling a mature unicorn. And again, that's just one category. So we've spent a lot of time on it, but I want to talk about some other categories. But it's a business that has really attractive economic characteristics, high growth, predictability. It may be investing to take market share at this point in time. So it's not generating a lot of cash today, but it's building out a great market position in a business that we understand and like, and using technology is going to be an important part of it. The other possibilities are, private equity is a very large category for us. The private equity firms buy businesses with a fair amount of leverage. COVID has an impact on almost every private equity business. We are an instantaneous $5 billion deleveraging and IPO event for a private equity controlled company. And the same thing's true for a family-owned business. There are a lot of generational wealth transfer. I'm a signatory of the Giving Pledge. Giving Pledge members are committed to give away half or more of their assets by the time they die. Their principal asset may be a family-owned, likely a family-owned business where they need, perhaps the next generation is not interested in working in the business, overseeing the business, and where public offering is the way to set up the business, if you will, for the hereafter, preserve the legacy of the family company. You get the benefit of public company governance, and we can offer an instantaneous solution to someone who doesn't want to go on a roadshow and take the next 4 months and find out, if Biden's ahead or Trump's ahead, it somehow affects their ability to get an IPO done.
Yeah, just really some interesting stuff that you just unpacked there and how you're kind of aligned with the investors and the incentives. I know you as an activist investor, and I don't just mean with your portfolio, but kind of in life, and whether it's your philanthropy and the signing of the Giving Pledge and the things that you look to change. And I noticed this in the S1 bill, more than half of the underwriters were either women-led or minority-owned or disabled veteran-owned firms that are underwriting this deal. I think he had 10 firms, more than half. So it makes me wonder about, really intention here and inclusivity, especially given everything we've gone through from the pandemic, the economic crisis, and of course, the social crisis that our country's going through right now. I was hoping you could elaborate more on your role as an investor to enact meaningful change.
Sure. Well, the good news is there's some very, very talented people that own women-owned, minority-owned, veteran-owned firms. And we've been aware of this base of firms, but we hadn't done an IPO in the U.S. before. And we thought, this is a perfect time in history to do what's right from a business perspective. And what's really interesting is, it's not uncommon for a big IPO to include a group of so-called inclusion firms in the IPO, but they're typically brought in at the 11th hour, a couple days before the deal is going to get done. They're given 1%, 2%, 3% of the economics, and they don't get to do anything, and they don't get stock to allocate. And I said, look, this is silly. It's not a win for the deal, and it's not a win for the banks. And so what we did is we brought the firms in, Loop and Castle Oak and others, and Robertson Ryan, and we said, look, we're excited about getting you involved. We're getting you involved early. This is not philanthropy. We're going to give you 20% of the economics, which is somewhere between 10 and 20 times what banks are typically paid. But you're going to do the work, and you're going to be part of the team, and you're going to add a ton of value, and you're going to lead to a great outcome. This is the largest IPO of the year. It's one of the largest IPOs in history. And without those firms, it would not nearly be as successful a deal. And, it's a win for them, it's a win for us, and it sets a precedent. If I'm a big institution investing in IPOs, and there isn't a broader, more inclusive base of underwriters in the deal getting real economics, then you know what? I'm going to challenge the issuer to say, why is that the case? And you start a self-fulfilling prophecy to the good. If you bring firms in, you allow them to create value, you allocate to them as many shares as they can sell, right? Which is what we did here. And that, you give stock to people in a deal that trades up, 8%, the first day, and you make friends with clients, you build a bigger base of clients, you generate more revenues, you can recruit more talent, and you're on a positive flywheel to make, so-called MWBE firms, a more important part of Wall Street. So I think we started a trend here that creates a precedent I think others should follow. And what I can tell you is we met a very diverse base of investors. We got one of the largest orders, through one of the firms for a great long-only, very well-regarded asset manager. We gave a very large allocation to one of the most famous names in the country, billionaire family, one of the wealthiest families in the country, participated in the deal, came through one of these firms, much broader base. And there was very little overlap, interestingly, between the introductions that were made by the big banks versus the smaller firms. And so it was a win-win for everyone. So great experience.
Bill Ackman, appreciate your time today. Certainly a lot to talk through there, but congratulations on the debut today. And our thanks to Julia LaRoche as well for bringing us that